Let's be honest. In today's market, there's a lot of risk in investments, which makes most investors prefer to keep their money in the bank. But what if you invested a little portion of the money, say a $10,000 investment in the SVOl ETF? Is it worth the risk? And how does it work exactly to make it a worthwhile investment? Well, in today's video, we'll explore what makes SVOl stand out, how it manages risk, and the potential impact of a $10,000 investment in this ETF. Without further ado, let's dive in. Now, the Simplified Volatility Premium ETF is a unique exchange-traded fund that offers investors an innovative approach to capturing income through the volatility risk premium in financial markets. Managed by Simplify Asset Management, SVOl is designed to exploit the market's tendencies to overprice short-term volatility, allowing investors to benefit from the difference between implied and realized volatility. When you dig deep, its core strategy revolves around shortening volatility, specifically selling short-term volatility future contracts. Volatility futures are financial instruments that allow traders to speculate on the future level of market volatility as measured by the VIX index, often referred to as the fear gauge of the market. Typically, these futures are priced higher than the actual volatility realized in the market due to the fear of sudden market shocks, creating an opportunity for investors to profit from this discrepancy. By shortening volatility futures, SVOl seeks to capture the premium that arises from this overpricing. The fund's managers systematically sell volatility future contracts, collecting the premium, and then close these positions as the contracts near expiration. This process is repeated, generating a continuous income stream that is distributed to investors in the form of dividends. The primary source of SVOl's returns comes from this income, making it particularly attractive to income-focused investors. Another thing that makes SVOl attractive is the high dividend yield, which is significantly higher than what traditional equity or bond investments typically offer. This high yield is a result of the fund's ability to consequently capture the volatility risk premium. For investors looking to generate a stable income stream, SVOl offers a compelling solution. The ETF's dividends are paid out regularly, providing a reliable source of income that can be especially beneficial for retirees or those seeking to supplement their regular income. Moreover, the high dividend yield makes SVOl an appealing alternative to other income-generating assets like bonds or dividend-paying stocks, particularly in a low interest rate environment where traditional fixed income investments may offer relatively modest returns. The consistent income generated by SVOl can be reinvested to compound returns or used to meet ongoing financial needs, making it a versatile addition to any investment portfolio. Now, when compared to other ETFs, SVOl has an advantage. As we all know, the SPDR S&P 500 ETF is one of the most well-known and widely held equity ETFs, providing broad exposure to the S&P 500 index. It aims to replicate the performance of the U.S. stock market's large cap segment, offering investors a diversified portfolio of leading companies. The primary appeal of SPY lies in its potential for capital appreciation and broad market exposure. Investors in SPY benefit from long-term growth through exposure to equities, which historically have provided strong returns. In contrast, SVOl does not seek capital appreciation through exposure to equities, but instead aims to generate income by capturing the volatility premium. While SPY offers growth potential through rising stock prices, SVOl offers high-yield income through its systemic shortening of volatility futures. This makes SVOl more suitable for income-focused investors, particularly those looking for alternatives to traditional dividend-paying stocks or bonds. However, SVOl's strategy is more complex and carries different risks compared to SPY, such as the risk of large losses if market volatility spikes unexpectedly. The iShares iBox Dollar High Yield Corporate Bond ETF is another popular ETF known for its focus on high-yield corporate bonds. It provides exposure to a diversified portfolio of junk bonds, which offer higher yield than investment-grade bonds due to their higher risk of default. Investors are attracted to it for its income potential, especially in a low interest rate environment. Now, when comparing SVOL to HYG, both ETFs cater to income-seeking investors, but through very different mechanisms. While HYG generates income from interest payments on bonds, SVOL generates income by capturing the volatility risk premium. SVOL tends to offer higher yield than HYG, making it attractive for investors looking for substantial income. However, the risk profiles of these ETFs differ significantly. HYG's primary risk comes from credit risk. If the issuing companies default, the ETF could suffer losses. SVOL, on the other hand, faces market risk tied to volatility spikes. Investors in SVOL must be comfortable with the potential for sharp losses during periods of extreme market volatility, whereas HYG investors are more concerned with the financial health of corporate issuers. Another one is the Global X NASDAQ 100 Covered Call ETF. It's an income-focused ETF that employs a covered call strategy. QYLD writes call options on the NASDAQ 100 index, generating income from option premiums while still holding the underlying stocks in the index. This strategy provides consistent income but caps the upside potential since the ETF may have to sell the underlying assets if the market price exceeds the strike price of the options sold. When comparing the two, SVOL and QYLD appeal to income-focused investors, but achieve their goals through different strategies. QYLD's covered call strategy generates income in a relatively straightforward manner, and has been popular for its ability to deliver consistent, albeit capped, returns. SVOL's approach is more complex, involving the shortening of volatility futures to capture the volatility premium, which can result in higher yields but also comes with greater risks, particularly during periods of market turmoil. QYLD is generally better suited for conservative income-seeking investors who prefer the combination of income generation with limited downside risk, as the ETF still holds the underlying assets. In contrast, SVOL might appeal to more aggressive income investors who are willing to accept higher risks for potentially higher rewards. Now that we've mentioned that SVOL is a bit risky, let's look at how it manages the risk in the market. Interestingly, SVOL is designed with risk management in mind. While shortening volatility can be risky due to potential for sudden spikes in market volatility, SVOL employs several risk mitigation techniques to protect investors. A core strategy SVOL employs is diversifying its short volatility positions. Instead of concentrating its exposure on a single volatility futures contract, SVOL spreads its position across different maturities and strike prices. This diversification reduces the fund's sensitivity to sudden spikes in volatility that might occur at a specific point in time. By holding various positions, the ETF can mitigate the impact of adverse market events on its overall portfolio, ensuring that a single spike in volatility does not disproportionately affect the fund's performance. For instance, SVOL might hold short positions in both near-term and long-term volatility futures. While short-term contracts are more sensitive to immediate market movements, longer-term contracts are generally less volatile, providing a balanced effect. This approach allows SVOL to capture the volatility risk premium while managing the risks associated with short-term market fluctuations. SVOL also employs hedging strategies as a critical component to its risk management framework. Hedging involves taking offsetting positions to protect against potential losses in the primary investment strategy. In the case of SVOL, the fund may use options or other derivative instruments to hedge its short volatility positions. These hedges act as a form of insurance, providing protection against large and unexpected spikes in volatility, which could otherwise result in significant losses. For example, if SVOl is shortening volatility futures, it might simultaneously purchase call options on the VIX index or other related instruments. These call options would increase in value if market volatility surged, thereby offsetting some of the losses from the short futures positions. This hedging approach helps to limit the downside risk of the fund, allowing it to pursue its income-generating strategy with greater confidence. Another important risk strategy SVOl employs is maintaining cash reserves and careful liquidity management. The fund keeps a portion of its assets in cash or cash equivalents, which can be used to cover margin calls or other obligations in time of market stress. This liquidity buffer ensures that SVOl can meet its financial commitments without being forced to sell off assets at unfavorable prices, which could occur during a market downturn. SVOl's approach to position sizing is another key element of its risk management strategy. The fund dynamically adjusts the size of its positions based on the prevailing market conditions and its risk tolerance. In periods of low volatility, SVOl might increase its exposure to short volatility positions to capture more premium. Conversely, during high or rising volatility periods, the fund might reduce its position size to lower risk. This dynamic approach to position sizing allows SVOl to adapt to changing market environments, ensuring that it does not take on excessive risk at any given time. The fund can optimize its risk-reward profile and maintain a more stable performance by scaling its exposure up or down based on market conditions. So, what can happen if you invest $10,000 in SVOl ETF? Well, investing in the Simplify Volatility Premium ETF can be a transformative financial decision, especially when starting with a $10,000 investment. SVOl is known for its high-yield dividends, which can be particularly beneficial for investors looking for income, whether for retirement, supplementary wages, or reinvesting to compound wealth. The ETF strategy focuses on capturing the volatility risk premium, which has historically provided consistent returns, especially in relatively stable or slightly volatile markets. For a $10,000 investment, assuming an average dividend yield of around 16% per annum, which is the current dividend yield rate, an investor could receive approximately $1,600 annually in dividends. The power of compounding is a significant factor in this $10,000 investment in SVOl, which can grow over time. Reinvesting the dividends received from SVOl can lead to the acquisition of additional shares, which in turn generate more dividends. Over time, this snowball effect can substantially increase the value of the investment. For example, if the dividends are reinvested and the ETF maintains its performance, the investment could grow exponentially, assuming an average annual return, including dividends reinvestment, of around 16%, the $10,000 investment could grow to over $35,000 in 10 years and possibly much more over a longer time horizon. This kind of growth can significantly impact an investor's financial stability, providing more options for retirement, large purchases, or even achieving financial independence. Over the long term, the financial impact of investing in SVOl can be profound. The investment can become a significant asset as it grows through dividend reinvestment and capital appreciation. For instance, if the investment strategy is maintained for 20 or 30 years, the accumulated wealth could be substantial enough to fund a comfortable retirement, pay for children's education, or even provide a financial legacy for future generations. Moreover, the steady income provided by SVOl can offer peace of mind, reducing the need for investors to consistently monitor the market or make frequent adjustments to their portfolios. This passive income stream can provide financial security, allowing investors to focus on other life goals, such as spending more time with family, doing some other projects, pursuing hobbies, or engaging in philanthropy. Also, SVOl's ability to generate high dividends can serve as a hedge against inflation. As the cost of living increases, the income generated by SVOl can help maintain the investor's purchasing power. This is particularly important in an environment where inflation rates are rising, as fixed income investments may lose value in real terms. By investing in an asset that can provide income that potentially outpaces inflation, investors can protect their financial well-being over the long term. So whether for retirement, income supplementation, or wealth accumulation, a $10,000 SVOl investment offers a promising path to financial transformation. So, what's your take on investing in the SVOl ETF? Does this strategy align with your investment goals? Let us know in the comments below. If you found this video helpful, give it a thumbs up, subscribe, and don't forget to turn on the notification bell for more amazing videos.